Welcome, listener. Today we're taking a deep dive into an options strategy that sounds kind of complicated at first, but stick with us because it's actually all about simplifying your market view, the straddle. We're going to break it down, no finance degree needed. Okay, let's unpack this.
That's right. And what's fascinating here is how straddles offer, well, a surprisingly straightforward way to bet on what you think the market's going to do. Our mission today is to really understand what a straddle is, its two main forms, and, how you might use them, whether you expect big moves or maybe surprising stability.
Yeah, simplifying sounds good. There's so much noise out there.
Yeah.
So how does this strategy actually simplify things at its core?
It really boils down to this. A straddle is just a combination of one call and one put option.
Right.
On the same stock, importantly, with the same strike price, usually right near the current stock price, what we call at the money, and the same expiration date.
Got it. Same stock, same strike, same date.
Exactly. You're making a really focused bet. It's about movement, or maybe the lack of it.
So I think you mentioned two main types, buying both or selling both. Is that it?
Precisely. You've got the long straddle, where you buy both the call and the put, and then the short straddle, where you sell both. And here's where that simplification really shines. A long straddle pays off if there's a big move. Doesn't matter if it's up or down.
Ah, okay. Direction doesn't matter, just movement.
Right. While a short straddle profits if the stock basically stays put near that strike price. It really cuts your decision down, big move or no move.
That makes a lot of sense. So let's say there's a big earnings report coming up for a company.
Yeah.
And I'm thinking, wow, this could really shake things up. But honestly, I have no idea if the stock will shoot up or just tank. That's when I'd use a long straddle.
That's the classic scenario. You use a long straddle to capitalize on that uncertainty, that potential for a big surprise. You pay the premium up front for both options.
And the risk.
Well, the great thing is your maximum loss is simply that total premium you paid. That's it.
Okay, that's clear. Could you maybe walk us through a quick example? Numbers
Yes.
always help.
Sure thing. Let's say a stock is trading right at $100. You decide to buy a long straddle. Maybe the $100 strike call costs $3.50, and the $100 strike put costs $3.20. Same expiration.
Okay, so total cost is $6.70.
Exactly. $6.70 per share. That's your total premium, your maximum risk. Now, for you to make money, the stock needs to move beyond your break-in points.
Which would be?
On the upside, it's $100 plus that $6.70 premium, so $106.70. On the downside, it's $100 minus the $6.07, so $93.30.
Right, needs to cover the cost of the options first.
Precisely. So if the stock jumps to $120 after earnings, your $100 call is worth $20. Subtract your $6.70 cost, and you've profited $13.30.
Nice. And if it tanks, say to $85.
Then your $100 put is worth $15. Again, subtract the $6.70 cost, you profit $8.30.
Huh.
Okay, big move. Either way, potential profit.
Okay, I see the appeal, but what are the risks besides the stock not moving enough?
Good question. Two big ones. First is what we call IV crush. Implied volatility, basically the market's expectation of future swings, often skyrockets before an event like earnings. After the event, win or lose, that uncertainty disappears and the IV can just collapse, crushing the value of your options even if the stock moved.
Oof, okay. 4V crush.
And the second is just plain old time decay, or theta. Every day that passes, options lose a little bit of value, especially as they get closer to expiring. It's a constant headwind for option buyers.
Right, time is money. Or losing money in this case.
Mm.
Okay, so that's the long straddle, betting on a big move. What about the flip side, the short straddle, betting on quiet?
You got it. With a short straddle, you sell both the call and the put at the same strike and expiration. You collect that premium up front.
So you start with money in your pocket.
Exactly. Your bet is that the stock will stay close to that strike price, and ideally, that implied volatility will drop too. Your maximum possible gain is limited to that initial premium you collected.
Limited gain, that usually means.
Unlimited risk, yes. Well, theoretically unlimited. Here's the critical part. Your maximum loss is potentially unlimited if the stock rockets up, because you're short a call. And it's very large if the stock crashes because you're short a put.
Whoa, okay, that sounds significantly riskier.
It carries what we call huge tail risks, that small chance of a massive catastrophic loss. And because of that, brokers will require substantial margin. You need a lot of capital set aside just to hold the position.
So this isn't for the faint of heart.
You definitely not. It's really a bet that the stock will pin the strike price finish right around $100 in our example at expiration. If it does, both options you sold expire worthless, and you keep the entire premium.
So using that $100 example again, if I sold the straddle for $6.70, I'd want the stock to close exactly at
It's
$100.
your perfect scenario, yes. You keep the full $6.70. You'd still make some profit as long as it closes between your break-evens, which are the same points as before, $93.30 and $106.70. But the closer to $100, the better for the short straddle seller.
So you're basically selling insurance against a big move, hoping it doesn't happen.
That's a good way to put it. You're betting that the market's fear of a big move, reflected in those option premiums, is currently overpriced.
Okay. So whether you're buying for movement with a long straddle or selling for stability with a short one, it does offer a sort of simplified lens on market expectations. Will it move big or will it stay put? So wrapping this up, what does this all mean for you, our listeners?
Well, it means understanding how even seemingly complex tools like straddles can actually help simplify your view, letting you focus on volatility rather than just direction. It opens up new perspectives. But it also brings up a really important point to consider, especially with that short straddle risk we talked about. It makes you ask, when you're looking at strategies with potentially unlimited risk, like selling a naked straddle, how crucial is it to always explore alternatives that define your risk?
Mhm.
Strategies like an iron condor or an iron butterfly, perhaps, to protect your capital.
Mm, Protecting capital versus chasing premium. Definitely something to think about.